Hello and welcome everyone to episode 4 of the WSBA's Understanding the Crypto Industry Principles. I am Ron Quaranta, chair of the Wall Street Blockchain Alliance, here with our good friends and colleagues, Nick Curley and Gavin Fearey. I'll give you both a moment to say hello to the audience, but before I do, our usual disclaimers, please do keep in mind that everything discussed is not to be considered accounting, investment, legal, or tax advice. Gavin's gotten tired of counting how many times he's heard me say that. But Gavin, Nick, please do say hello to the audience. We'll have some more follow-up and logistics after that, and then we'll dive right into the conversation. Gavin, you want to start us off?
I'm very excited with Winstead in the Fort Worth office in Texas, and have been working and really value being part of WSBA's legal working group for some time, and have been focused on custody issues for the whole time.
Thanks. Nick, please do say hello.
Hi, y'all. I'm Nick. I work closely with Gavin, and I'm also a member of the WSBA. And we're a lot of fun working on many different projects, including this one, talking about custody of digital assets.
It's good to see you both. For those in the audience watching us on LinkedIn Live, thank you for joining us. We do take questions throughout the broadcast. You should have a chat function there. Please do submit your questions. We'll get to them as soon as we can. Gavin, let's dive into it. The section that you had both very much focused on that was critically important for our crypto industry principles was custody and segregation of assets. And, we've seen a lot of background in the challenges around custody. We've seen a lot of rulings or proposed rulings around custody. Gavin, you and I and Nick and others collaborated on a submission to the SEC, for example, on qualified custodian status. Let's kind of lay the background there. What has custody and segregation of assets looked like previously in the crypto world? And where do we see it needing to go? And how does that tie into our principles? Gavin, do you want to kind of kick us off with that landscape there?
Yeah, for sure. So, protecting customer assets by keeping them apart from providers' assets is really a basic principle that has been in federal laws and some state laws for a long time. So if you go back and you look at that, we were just talking about the Advisors Act that for investment advisors, and that the custody rule there that's been in place for many, many years. And it has a corresponding partner in the Commodity Exchange Act in requirements for brokers, et cetera, to keep customer assets segregated or separate. So really, it should not be of great surprise. And this is one area of law in which there should be bipartisan agreement that having adequate requirements to segregate assets are just a starting point for other things.
Nick, do you want to weigh in here? And I think what it'd be interesting for the three of us to do is I want to tell a little bit of the tales of how we've seen custody handled previously in some public-facing companies. But Nick, what are your thoughts on some of that background of custody?
Yeah, I think I would echo what Gavin has said, and also that it's encouraging to see state legislatures take positive steps towards enforcing more reasonable approaches to custody and segregation of assets in the digital space. So, absolutely agree.
Gavin, Nick, I want to paint that picture a little bit more. The three of us and so many of the WSBA members have been deeply involved in crypto and blockchain and tokenization for many years now. One of the things that we had seen was this idea that industry participants will say, well, the custody of TradFi and segregation of assets in the traditional finance world, well, that doesn't really apply to us here. And we've seen the fallout from some of that. We can certainly talk about FTX. We've seen others in this space. Was that a legitimate position for industry participants to take? And my argument has often been the closer you align with TradFi, the greater you'll get TradFi acceptance in the ecosystem. But Gavin, we've seen some ugly stuff in the past. Can we dive into a little bit of that?
Yeah, let's go there for a minute. So you really start off with not your keys, not your coins as a basic principle. If you have strict segregation where you would have your own wallet, and either you would be the one controlling that wallet, like it might be a wallet where there are private keys where you have control 2 of 3, a multi-signature wallet, and you have direct access to the network. Maybe it's Bitcoin, for instance. Then you go to sort of a model where, for regulatory reasons, you need to have a second pair of eyes or a custodian, an independent entity holding those assets, which really means for on the blockchain that they're holding the private keys that allow you to access, or the other credentials that allow you to access that particular wallet or place, record, really, on a blockchain. So I think that there is a lot of nuance, and that the whole idea, for instance, what is commingling? Is it okay? When is it okay to commingle, etc.? And so commingling customer assets with other customer assets, there may be security trade-offs or trading trade-offs and reasons why customer assets, the assets of more than one customer, would be set up to be commingled. And that's a sort of design trade-off for cybersecurity, and a sort of a trade-off where strict segregation is not the only priority. And then you sort of go down your list and you move to and again, like even here, you have to think, are we talking about segregation in a books and records level? Like, are we just talking about an entry where a digital asset provider says this wallet just has customer deposits in it, or is it just a book entry, etc.?
Right.
And then the next level is where the customer assets are actually commingled with the platform assets. And that might arise in a situation where it's not really about custody, where it's about using the assets, where it's about lending, etc. Or there may be contexts in which the customer assets get used and not just held separately. And at that point, they will go somewhere else. But I think the basic principle is that platform assets, with very limited exceptions, shouldn't be commingled with customer assets. And I think, to your point, Ron, people have been kind of lazy in some cases about saying, look, as long as we're just doing this at a books and records level, that's always sufficient, etc. But there's a lot of nuance at the wallet level, making sure the wallets are appropriately labeled and shown as belonging to a customer, which can have its own challenges. So I think those are the nuances, Ron. I think there has been some laziness, and it's clear that some basic level of segregation is necessary when it's not fully segregated, not your keys, not your coins.
And not to be too critical about it, Gavin, in some instances, we've seen book records being really sloppy Google Sheets that are probably not best for a professional organization. Nick, I want to turn to you on this, and I kind of want to expand upon some of what Gavin's talking about. Has this led to, and I hate to use this phrase, but rehypothecation gone mad in the crypto space when we see how some tokenizations, I'm kind of ripping up the script. I don't even think I put rehypothecation in the prep notes we had, but that's led to some pretty messy things, right? Like we all know in the equities world, for example, we could talk about stock loan, stock borrow as an example of that. This is a different animal, right? Nick, what are your perspectives on that?
So it's interesting you say that, and I would go back to your previous point that, talking about how actors in the space sometimes feel that they are not beholden to the same rules and regulations as TradFi. Now, I think that the same stands for digital assets, that I echo Gavin's point that rehypothecation of assets, there is a place for that when done properly. And in terms of the customer needs to know, and having proper disclosures of rehypothecation is important. But that's what I would say about rehypothecation.
Nick, thanks. I appreciate that. I want to, one of the things we added when we were talking about the creation of the crypto industry principles, and we looked at segregation of customer assets and custody was, and we noted it very specifically, quote, clear and concise disclosures of all terms of service. Gavin, I want to play devil's advocate here a bit. And the oft-used example that I have is when you look at the disclosures from things like OCC, if you're trading options or just a basic equities account, the everyday person's not going to read those, right? At least I would argue that, unless they're in the industry and doing what the three of us do, for example. Why is it better if it does this, if it's done in the crypto space, and why is it important that it be done in the crypto space, that we have these clear and concise disclosures? And what have we seen in terms and conditions that they put out there previously, at least?
Yeah. So I think you've seen some that were very thoughtfully put together, that have led to different outcomes in bankruptcies, et cetera. And then you've seen some terms of service that were, frankly, a little bit confused on some basic issues. And so I would push back on the idea that, that traditionally the U.S. is pretty good at disclosure. Yeah, I admit, being a lawyer, that I've written some very long sentences in my time. However, there's no reason why there shouldn't be plain English disclosure. Either we're taking your assets to hold them for you to access them. They will always be owned by you. You will or will not be able to get back exactly what you put in. Or this is a fungible asset and we'll give you what we have. Or any disclosures like you were mentioning, rehypothecation, that should be absolutely transparent and absolutely clear. If you go to your favorite restaurant and you hand over your keys to the valet, you do not expect to come back, and you go in with a black Lexus. You don't expect to come back with a bright yellow Lexus and then someone say, you know what? It's fungible. It's a Lexus. It's got the same amount of miles on it. And you should know when you hand over your keys what it is that you're going to get back and where it's going to be held. And likewise, if the valet is allowed to put some miles on the Lexus and maybe take it to a racetrack and maybe sell it a couple of times to someone else, etc. And then as long as they think they can get it back in time, that's probably something that should be pretty clear on a customer agreement.
Nick, Gavin eats at fancier restaurants than I do, but I'd love you to weigh in on that perspective and expand upon some of that. What are your thoughts there?
Yeah, I agree. And to add on to Gavin's thoughts, just that the onus really should be on the service provider to make it clear. And disclosure is, only going to be as good as it is tailored to the specific situation, and it's only as good as far as a consumer is willing to read it. And so, to your point about concise and clear language, that really is the rub. We want these disclosures to be in plain English so that they're actually useful for the consumer. And to know when you're getting a different color, fungible car, Lexus. So,
as they're parking Gavin's Lexus, we'll have a conversation about fungibility. I want to stay on that for one quick moment, Nick, if I could. That really brings to bear, and I won't mention, but there's a very large U.S. crypto exchange. When we talk about being clear and concise in these disclosures, you could argue. Let me rephrase that. This is not the argument that no one in crypto has been clear and concise. And I would argue that a major participant in the space, for example, was very clear and concise in their staking program. Gavin, you had mentioned, I forgot the name of the specific program, but that ownership and your keys, your crypto, that you have sole control. In many instances, for the professionalized players in the space, that's very clearly delineated. Would you agree that that's the majority of participants, or is this just because this one instance is a public traded company, for example?
I would say that the customer, I looked at a lot of custody agreements if in the digital asset space, and frankly, they were all over the map, even for large entities to start with. And the rules about whether they're held in bailment and who remains the owner, is it just transfer of control versus transfer of title? What are you allowed back? Are we allowed to basically give the asset to another subcontractor to look after, and what are our obligations there? I would say there really was no standard, and there was some room to negotiate if you had a fair amount of assets. But I would say, sure, there are some shining examples of solid disclosure, but there also was just a lot of the contractual arrangements, which were all over the map.
Yeah. Gavin, Nick, can I rip up the script here a little bit and dive onto that for one more point? Would those lack of standard or unified or uniform kind of disclosures, were they a net negative for those customers who got caught up in crypto bankruptcies? Did it make it harder for them, or is there no parallel there?
I think that a lot of people sort of made a bet that said, you know, we are or are not in a position to negotiate. Therefore, I'm just going to go with what the market can give me right now. And some people probably had very there has to be, if you're looking after other people's assets, it has to be pretty clear that you have limited control over negotiation of those agreements, and that there is significant risk. But I think probably there are a fair few people that entered into agreements with some very large entities that don't exist anymore, or at least going through the tail end of a bankruptcy. And so I would say that is I would say there's probably some remorse there, because perhaps it wasn't worth it. The risk wasn't worth it.
Thank you, Gavin. Thank you, Nick. I want to move forward. One of the things that you had both very specifically raised in this section for the crypto industry principles was, and I'm going to quote here, regular and independent verification of all customer assets and accounts. That's a big thing in this space, and that's a challenging thing to do. No, not least because, and you might have both seen it, the SEC's chief accountant recently put forward, I don't want to call it guidance, but certainly a statement around accountants and auditors. Careful what you audit, and you better be clear and you better do it right. Almost this kind of wet blanket of stay away from this space. How hard are regular and independent verifications, and who would do them? You know, we have a global partnership, you know, shout out to our friends at AICPA, but doing the audits themselves is very hard in this space. Nick, why don't we start with you? What are your thoughts about that? And we understand the importance of that independent verification. In the current market, how practical is that independent verification?
It's an interesting point. And the conversations that I've had with auditors, it's primarily been around just technical unfamiliarity with the system. That's a huge learning curve. But you know, on the flip side of that, I think that auditors that are comfortable digging into the technology and familiarizing themselves with it will have a competitive advantage once they get on the other side of that. I don't think we're there yet. I think that, yeah, you're absolutely right. Right now, auditors are nervous to take on these projects, especially given guidance. But I think that there's a future opportunity.
Yeah. Yeah, and to Nick's point, that auditors are nervous is probably, Nick, congratulations on having more understatement than the English person next to you. The auditors can't get insurance from the insurance they require, and so there's more levels to this. First, there probably has to be a law, like in the Loomis Gillibrand case, where an annual verification of assets under custody would actually be required. And it would mandate the PCAOB to implement standards and to consult with the SEC and the CFTC. And so you're rightly pointing out, Ron, there needs to be standards. And those are not even close in many ways. And so there has to be some level of assurance that's lower in the meantime. But so first of all, you need a law that probably mandates it. And in Texas, for instance, we have a law that's requiring certain digital asset service providers that will come into effect shortly to provide some proof of reserves attestations filed with the Texas Department of Banking. So you probably need a law, and you need a law also at the federal level. Then you need standards, PCAOB, and then you need to be able to get the insurance to do it. So this has been very much a slow moving train that hasn't gathered steam, except for some notable exceptions. The other thing I want to say, Ron, is obviously, people, certainly there are many politicians as well as people who rightly pointed out that proof of reserves has been a failure in a spectacular way if inappropriately implemented. So if you go into the accounting environment that, for instance, prevailed in FTX, you can read about in the bankruptcy filings, where you didn't even have key functions like a chief financial officer or a chief internal auditor in certain departments, and so the people arriving to sort of do their proof of reserves are then perhaps not being given QuickBooks manually transferred from an accounting system. They're being given access to wallets that might not be clear who they belong to.
Right.
And so you could cryptographically prove that you've transferred customer assets to an affiliate, or that there is a wallet containing assets, but whose those are has to be all internally verified. So you need strong internal controls, and then you need these external mandates. There are some firms doing some good proof of reserves work, but this whole system has to catch up.
And in fairness, proof of reserves work, to your point, it could be messy manual, messy kind of, we don't know where all the data is or who owns this. And it's only as good as what's disclosed from a wallet perspective, I would argue. Gavin, I want to, you and Nick, if I could ask you to both weigh in on something. I want to go back to that SEC chief accountant's perspective. We had talked about this several months ago. The SEC's chief enforcement officer, I believe, had put forward, I'm ripping up the script again, sorry, Gavin, have put forward, hey, you lawyers, you better be careful about working and advising crypto. I'm paraphrasing. It was much more elegantly stated than that. Is this similar for what they told the accounting world? And is this meant to dampen the accounting and legal profession's engagement in this space? I know that's a bit of a provocative question, but I think that's a question people in the industry are asking.
I think the answer is yes. And and it's fairly obvious to my personal view that is the case. But that doesn't mean that you don't do anything on it. And it doesn't mean that inappropriate proof of reserves isn't a requirement. But it does mean that if cryptographic proof that assets are available when done in an appropriate way that doesn't jeopardize the safety of the doesn't create cybersecurity risk, is immensely valuable as a tool. And it has a place. And I think it's great that Texas, for instance, for certain digital asset service providers, and then in proposed legislation like the Lummis-Gillibrand bill, would actually mandate some level of verification of assets and give some firepower to require the PCAOB to implement standards, which, as you know better than me, will probably take a little bit of time.
I was going to ask, how realistic of a time frame are we looking at when we look at PCAOB, which for years had said it's not material or pervasive enough to be of interest at all, or how realistic are we in hoping that legislation is passed? This is not the McLaughlin group, Gavin, if you and I go back way when, but this is a multi-year conversation then, if that's the case. None of this is happening quickly, correct?
Yeah, that's right. And that there's that old maxim that people overestimate what they can do in a year and underestimate what they can do in 10.
Yep.
If it's 5 or 10, depending on how effective you think you are. But the truth is that custody has been, took the SEC from 2017, 2018, 2019, many, many years to come up with a proposed rule that came out earlier this year. So in terms of how fast things are moving, you're right, but we couldn't need clearer evidence of the necessity of these basic controls. Just go look at that. Just let me rant for a minute. I really encourage you to go to the Kroll website that has the FTX filings and look at the FTX second debtors report, right? I had nothing better to do. I absolutely loved it. It talks about commingling and reasons why commingling happened, allegedly. And in some cases, it was in order to be able to check the boxes on getting bank accounts opened in the right place. And there were sort of supposed payment agent agreements between sister companies, etc. And so the ideas, there's no question there were poor controls and probably fraud, but the basic principle that there should be assets should be kept separate from your platform assets. Wallets should be clearly labeled. We should have some level of verification. Like, that is not difficult, and I would push. It's not there. We've been to the moon. I think we should be able to have the accounting profession come up with some PCAOB standards.
Gavin, I think so many of the things, pardon me, that we've seen over the past 30 years, as I look into the crypto world and I see some of these things happen, I think in a previous life that was common sense. Now it's suddenly not happening, and sometimes I read these filings and thought, what were you thinking not doing this, at least from a business management perspective? Nick, do you want to weigh in on some of that? There's a lot we can unpack, and I want to ask if you're reading these filings on a Friday night the way Gavin is over a nice glass of wine.
Maybe a Monday morning reading for me, to be honest, but still a read. I agree with Gavin, and to expand on Gavin's point, I mean, these are not issues that are, endemic only to digital assets. We're seeing these problems that exist in TradFi. So we've, developed a good scheme regulatory scheme to deal with these in TradFi, and I think that being able to port over the wisdom from those schemes along with our understanding of this new technology is going to be important, and to be able to adapt those solutions to new problems that are being presented here.
How difficult is this, Gavin and Nick, when we talk about, so let's get into some of the esoterica of it, right? If I have an account at, let's just say, a Coinbase, things like disclosure, things like identifying who Ron is and KYC, AML, we get the importance of that. That's something firms like that try to do well. But when we look at the nuances of what's happening in the crypto space, I'm specifically thinking of DeFi. I'm specifically thinking of cold storage, unhosted wallets, for example. When the three of us sit there and say, look, disclosures are important, know who's who, know whose assets are whose, and whose are not part of Omnibus, for example, is it a harder conversation than we think because of the nuances of what we can do in the crypto space? Gavin, do you want to give some thought to that? Again, I'm getting a little extemporaneous here, but it's not a straight equity. They're very different capabilities in this space.
That's true. That's true. Although I would probably push back and question how many people who have securities, or security, more correctly, securities entitlements in their brokerage accounts, if they really know who's owning it, if they really know that the ultimate owner is Seed and Company, CEDE, and understand what it is they actually own. And so, because it's new, everyone wants to look under the hood and say, how does this engine work, right? And yes, there needs to be disclosures about what type of engine you have and its basic power and what it's fit for. But I would sort of push back in the sense that we use technology every day without and know the boundaries, but we don't really understand precisely how they work. So I would sort of, I think that the idea that it's just too complicated is probably wrong. I probably admit I would struggle sometimes to get some people to understand the difference between a hosted wallet and an unhosted wallet. They probably lose interest before I really got to the punchline.
Yep.
But I still think there's a place for simple disclosures, and frankly, in an institutional space, complex and disclosures and liability apportionment.
So, Gavin, my old Standard Oil stock certificates, I still have control of those. I'm not sure if I can get a quote on them, but thought I'd share that with you both. I want to pivot a little bit. Thank you. Nick, Gavin, I want to talk a little bit about, one of the other things we called out very specifically, and I don't have old Standard Oil certificates for the record. We noted that all segregated or omnibus account arrangements are relevant to customer assets. I know this is expanding a bit upon what we were talking about. Did you have a thought in mind when we said relevant? And what I mean by that is, would it have been better if XYZ exchange that went bankrupt had clearly labeled omnibus accounts? Would it have made a difference whether or not they're using their own homegrown token, for example? Like, how do we dive into the details of relevant in this context? Nick, do you want to give some thought to that?
To be honest, I think Gavin might.
I'll take it. I'll take it. I'll take it, Nick. I'll hand it back to you. I'll get it ready for you and then hand it back.
No softballs here today, gents.
So I agree with you. There are some nuances, in the commodities space. Brokers are allowed to put in a certain amount of platform assets in with the customer assets, for instance, in order to make sure there are no shortfalls and that everything's going to work. But it has to be disclosed, and there's rules about who owns that excess. So there are some nuances like that people are not likely to be focusing on it unless you're sort of on the business end or a lawyer. But understanding whether your assets are set aside in one wallet for you or set aside in a wallet containing only customer funds, or the circumstances on which those basic level could leave that wallet and go somewhere else, go off to an affiliate, go off to a different company entirely that controls, the private keys, that controls a different wallet. I think you should know how your assets are held and where they are held, at least at a high level, and how they will be used.
Yeah, I want to peel back that a little bit, knowing how your customers are held. And shout out to our old friend David Brill. He and I have had this conversation a lot. And you kind of alluded to it a bit earlier, Gavin, kind of the user experience, right? Knowing who's got control of our Schwab account, for example, versus who's got control of a particular wallet. Again, I would argue are different things. And I would also argue that the UX, the user experience for folks in this space looking for control on their own of their wallets, that's probably not ready for prime time for the majority of people. Would you both agree with that?
I like the idea of collaborative custody, where some portion of what you own is held with keys that you control. I think there's some value still some value to that. And so I would, in an institutional context where there's rules that require no one person being able to, misappropriate assets. Yep. And there's needs to be second sets of eyes on the assets. There's cryptographic ways to do that, but there are situations where it would be appropriate to have the assets held safely by a qualified custodian, etc. And I would agree with you that there's all sorts of levels. I mean, you could have multi-signature where your client has a key and then a service provider has a key and can assist you getting a backup, etc. So there are those. I might be a little more open to that than some people. But there are other situations where it can be a hosted wallet where they have control over all the keys. And that is a solution. So I think just like you would keep certain of your money in a regular bank account or some kind of PayPal balance, or there's different types of money that need to be held in different ways. And so if some of it needs to be in a vault safely, that's perfectly appropriate in some situations.
You referenced PayPal. Don't make me go down the PayPal stablecoin route. We can do that at a separate
Okay.
section that we're going to do. Nick, anything you want to add to that?
Yeah, I think that it's great that the industry is able to provide these different levels of solutions to customers that have different risk tolerances and different needs for risk mitigation. And so, what works really well for an institutional client is likely not going to be the same solution that a retail investor needs. And so, it's one of the benefits here of this technology is that we can fit have a little bit more of a bespoke solution for
Right.
customers.
Nick, thank you. And for all of you in the audience who attend or are attending, thank you so much for joining us. If you do have questions, please put them in the chat. If not, you can email us later on, info@wsba.co, and we'll reach out to Nick and Gavin and get some feedback. Gavin, you queued up something very interesting for me and made my life a little bit easier, so I'm grateful for it. You mentioned qualified custodian. And back in the day, it feels like forever ago, I don't even think it was a year ago, we, the three of us and several others, had collaborated on a submission to the SEC on qualified custodians regarding to the SEC.
Yeah.
Is it your viewpoint that the SEC really only sees a handful of qualified custodians, or if any, in this space, and that the custodian solutions in the space now are just not suitable? What's your take, I guess, on government's perspective, to the extent you can speak on this, around what's a real qualified custodian in this space?
Yeah, let me give you an example. So let's say, because there's sort of a hesitance that is just meant to, some regulatory hesitance might be meant just to create delay and control the size of regular people's exposure to certain assets. But there's also some valid points. So if you take an example of a trade, if I keep my assets, my private keys, in cold storage, right? So I have my assets are on the blockchain, but the private keys are held in a device that's not connected to the internet, etc. If those need to, I need to spend from that wallet. In the early days, and in some cases still, in order to make that trade happen, those assets would have to come out of cold storage, go into a hot wallet connected to the internet, and get exposed to different risk. And then they would go get transferred off to another platform, an exchange. So if you're a custodian doing that, they would actually be leaving your custody to go to an exchange to get the trade done, be on the exchange for a little while, and then come back and go into storage in the appropriate way, a hot wallet or a cold wallet. And that is a whole set of risk that you could see a regulator like the SEC saying, wait a minute, the assets are supposed to be with a qualified custodian. Oh, but there's this bit in the middle where it just isn't. There's a sort of a very genuine regulatory interest in at least, and in the SEC's proposal, having the custodian participate in any change of ownership, any movement out of that wallet, or change in any transaction. So I'm not saying the balance is right, and I think there is, under the current administration and SEC chair, a use of these rules to slow down the growth of the industry. But there is a legitimate interest where the qualified custodian should probably have its hands on the assets that it says that it should.
Yeah, and that handoff is where, and you mentioned this a bit earlier, Gavin. I think people underestimate the potential cybersecurity risks that are injected into that ecosystem when you have these multiple handoffs. Nick, do you want to add anything to that? And I do want to stay on qualified custodians with one more point, but Nick, would love to hear your thoughts on that.
I agree with Gavin. I think that, echo my previous point, that when you have a situation where a client is not aware of certain risks that are being taken by these qualified custodians, that needs to be disclosed at a minimum, apart from whatever the regulator is saying. I think that clients deserve to know what exactly they're signing up for when they sign up for it.
Nick, thanks. Gavin, I want to, while we're on qualified custodians and that kind of regulatory perspective on it, the other side of that are the big custodians that the three of us know in traditional finance right now, managing trillions of dollars. We all know, and it's public information, that they've been engaged in blockchain in some way for several years. Do you think the traditional finance qualified custodians, Gavin, are kind of waiting in the sidelines until there's better regulatory clarity? You could argue that they're best positioned to be, again, quote unquote, qualified custodians for the crypto space, but none of them has really come out in a big way to be a part of it. Do you have any thoughts about how TradFi institutions are looking at custody in the crypto space?
I would say, You're right. I would say when there's different types of waiting and watching, right? There's waiting and watching where you're watching the TV and every so often you're checking on something else going on. And then there is the type of waiting and watching where you're building infrastructure, entering agreements with other counterparties, designing your system, hiring people, where you're essentially sort of ready to go or close should the environment change. So I wouldn't want to intimate that there's not a massive amount of planning and openness and desire to participate at the highest levels in digital assets on behalf of the institutions that you reference. I don't doubt that for a minute. I would say that a change in regulatory stance in certain areas would be very welcomed, in a way that could allow both traditional custodians and then natively digital companies that have set up themselves and grown from the start with an awareness of blockchain. And some combination of those is very likely. I would also hate to see all of the assets getting I would hate to see a situation, or let me put it a different way. I would expect that there will be some partnerships between natively digital companies that sort of grown up with the blockchain and the larger, more traditional institutions. That could be very fruitful. But I don't think it would be a good regulatory approach to only allow the largest institutions to participate, but then to effectively use subcontractors in a way that actually doesn't protect the customer.
Yeah, and
So
introduces
there's a lot of nuance there that's very important.
Yeah, and introduces some of the risks that we talked about a bit earlier. And for the record, waiting and watching is not binge watching Stranger Things on Netflix, correct? That you're doing the people are doing some stuff in the background. We're running up. We've got a few minutes left. I want to start rounding out, Gavin and Nick, if I could. One of the things we've talked about with our crypto industry principles, and for anyone in the audience who hasn't seen them, you can go to our webpage, WSBA.co. There's a link right to our crypto industry principles. Release 1.0, we're calling it. And as the two of you know, we often called it nonpartisan, platform and regulation agnostic. It's really meant to be, I don't want to say code of conduct. I probably say that, Gavin and Nick, too much. But it's really meant to be a guidepost around, look, here's how you should operate in this business based on the knowledge and experience of so many people across so many different industry verticals. I want to ask the provocative question. And Gavin, you kind of referenced it. Is it a politics game, unfortunately? Are we waiting for administration change? Are we waiting for an SEC chair change? Is that what the industry requires, or is there still work that can be done within the context of what we're seeing, almost this open hostility in many regards to crypto? What's the biggest roadblock there? Nick, do you want to start that?
It's interesting that you paint it, or that we've set it up as a political issue. I don't necessarily think that that's the case. I think that it is an education issue, and we've seen that in the Texas legislature specifically, that sometimes encounter some hostility based on misinformation, and that when you sit down and have these tough conversations with legislators, they are sometimes able to come around and have a better attitude towards things, a more reasonable attitude. And so I would say that unfortunately, right now politically, maybe that is one way to look at it. But I think that we can overcome that issue with better education.
Gavin, do you want to weigh in there? And if you want to spend a moment, we have colleagues in Texas, we have colleagues in Wyoming. Each of those states is working on legislation to move things forward. If you want to talk a little bit about what's happening in Texas, to the extent you want to do that, Gavin, feel free.
Oh, thank you. Appreciate it. Definitely take you up on that opportunity. So I just want to kind of, to your point, the easiest way is obviously to come at this in a very in a way that is not very expecting of change quickly, right?
Hmm.
So to sort of, but there's, I mean, you have to think about the legislation that we've got right now that's been pending in the federally in the House and the Senate, the Loomis-Gillibrand legislation out of the House,
Yeah.
passed out of committee. I'm going to talk about that for a minute. The Fit for the 21st Century sort of piece of equivalent legislation.
Yeah.
These have come out of two committees, right? The committee, the agriculture side that controls the CFTC, Commodity Futures Trading Commission, and the Finance Committee or Financial Services Committee, depending on which you're in the House or the Senate, that controls the SEC, if you like, or at least it interacts with the SEC, controls budget, that kind of thing. The fact that both of these pieces of legislation have been through both committees on the ag side and on the financial services side, that is something that some people thought they'd never see. There's that sometimes the CFTC and the SEC historically have not cooperated historically, and single stock futures were banned. So there's reasons why. But so progress is slow, and back to the old adage, we may not see it what we want within a few months or a year, but look ahead, it's coming. When you see the Federal Reserve come out and say, I want to, as it did yesterday, with a novel activities supervision program, you can sort of see it two ways, right? You can say, oh, this means they're going to exercise their veto right and make sure state banks can't move forward in these areas, etc. So you can look at it skeptically like that, and that may be correct in the short term. Or you could say there is a ground being taken or a flag in the ground where these issues are going to come up, and it may take a few more years before we get the progress that we're looking for. But over time, it's inevitable. The fact it's come out of committee, both those committees means at some point congressional action is inevitable.
Yeah, we would not have imagined that 2 years ago, Gavin, in these conversations that the three of us have had. And the one thing I'll wrap up with in that context is the names in TradFi that are pushing forward on greater engagement in crypto, that list grows. I mean, we didn't even get to talk about, and we'll do it at a future session, ETFs, for example. And it is not Ron Q trying to create an ETF in crypto. It's BlackRock and many other multi-billion-dollar firms. There was an interview this morning. David Rubenstein was on Bloomberg Radio, and he noted that when you look overseas, governments in markets around the world are working very hard to engage in crypto and engage in Bitcoin and these others, which means it's not going away. So there is the challenge. I agree with you, Nick, of education. We do quite a bit of that with and through our members. We'll probably be visiting DC. We're not a lobbying organization, but there's still, the fear I always have is the pace of innovation accelerating and regulators can't keep up. So we're hopeful that gets better over time. I've got nothing left on the agenda. Gavin, Nick, any closing comments you want to make or anything you want to add to some of the stuff we've talked about and your perspectives on where segregation and custody goes in the future? Nick, do you want to start? Any thoughts you have?
Sure. I think that these principles laid out for custody and segregation of assets are going to be increasingly important towards the adoption of blockchain technology. And I think that by following these principles that we've laid out, these industry participants are being good citizens of the industry and are helping facilitate that adoption and is going to continue to change how we do business and think about money and how we interact with regulators and government. And so I think that, absolutely, that industry participants should really take a look at these principles and think about how they're applicable to their own business models.
Yeah, and Nick, to that point, just real quickly, none of these was created in a bubble. All of us collaborated with a few dozen folks across many organizations. It really is a voice of industry on principles in this space. Gavin, do you want to wrap us up? Any closing thoughts you have? Anything we need to cover in future sessions? And as you call from your compound in Texas.
A shout out to the Texas legislature for passing bipartisan legislation overwhelmingly that requires some of the larger digital asset platforms to segregate and keep customer funds separate from platform assets, and also taking a first step on a responsible use of proof of reserves. So shout out to them. Also shout out to the work happening on the federal level in the House and the Senate, where similar protections are in those draft legislation.
Indeed. Gavin, Nick, always a privilege. It's great to be collaborating with you on this. There'll be a release 2.0. We've got our big event happening in the autumn where we'll dive even deeper into this with industry participants. We'll leave it there for all of you in the audience who could join us. Thank you for joining us. The recording will be available next week on the WSBA YouTube channel. If you have follow-up questions for Nick or Gavin, email us info@wsba.co. We will get answers from the smart people. Gavin, Nick, again, thank you so much. It's such a privilege.
Thank you, Ron.
Thank you, Ron. Really enjoyed it. Have
Bye-bye.
a great one.